Hello and welcome to today's fund review. For this week, we're going to work on Fidelity Low Price Stock Fund. So what we do on Tuesdays is in our Facebook group, we put up a list of 10 funds and people in those groups can vote on which of those 10 funds they want to see an in-depth review of. So those 10 funds for this past week were mid-cap value funds, which Fidelity Low Price Stock is obviously one of. That got the vast majority of votes. And what we did for the other funds, actually all 10 funds, is we put together short videos, 2-minute videos, just focusing on the data without any analysis on top of that. That's just so the people who voted for funds in there don't feel like they got left out. They can see those videos on our YouTube channel that's under the short fund reviews. So you can go in there and see all the different mid-cap value funds we reviewed in short form. But for this video, we're just going to be focused on the Fidelity Low Price Stock Fund. The Fidelity Low Price Stock Fund is a mid-cap value fund. That's the category Morningstar puts it in. So if you think of that in terms of the style box, we have large cap funds on top, small at the bottom, growth funds on the right, and then value funds on the left. So this fund in particular does move around a little bit in style boxes. So we've seen it as a mid-cap blend fund. We've seen it as a small value fund. And that's more a reflection on the stocks that are in their portfolio, moving the classifications that they're in, not necessarily a reflection on how the management runs this fund, deviating from their style. Their style is to invest across the style box, really. So you'll see over 25% of the fund in large cap, over 25% of the fund in small cap. You'll see value and growth stocks in this portfolio as well. But if you had to pick a style box, it really just gets zeroed in on mid-cap value. So in the prospectus, they want us to compare this fund to the Russell 2000 Total Return Fund index. So Russell 3000 basically has most of the stocks in the US, and then the 2000 is a subset of that. The 2000 smallest is measured by market cap. So for the purpose of this exercise, that's the benchmark we're going to use to compare it to. But again, sort of tough sometimes for a fund like this to compare it to a particular benchmark. A reminder that this video is just general education. Nothing shared in this video is to be considered specific legal, tax, or investment advice. Don't act on any information you see in this video or in the Facebook group without first consulting your tax, legal, or investment advisor. We are an independent investment advisory firm. We have no affiliation to this reviewed fund, and we may or may not have a position in this fund with our clients' assets. This fund has been around since 1989, with Joel being there for the whole time. We have 11 years average manager tenure, and that's because he had a team that recently came underneath him, which pulls that number. But 11 years is still a significant time period for management team to be at a fund. And this fund is actively managed. So that's as compared to a passively managed fund. So passively managed fund, think index funds. They're essentially picking stocks from a list that's weighted or something based on a certain formula that list is put together on. Actively managed means there's a person like Joel or his team that's actively selecting stocks to maybe be weighted more than the index or weighted less than the index, or going outside of their mandate a little bit to look for other opportunities. This is a really good size fund, good size meaning big at 33 billion, and has over 800 holdings. Both of them are big numbers for mid-cap value funds. So the size sometimes can be a detriment to a fund like this because they can't take big positions in really small stocks just because of the size of their fund. It just simply wouldn't make a difference overall to their portfolio. But one of the things that does help them with here is on their expense ratio, which we'll see is less than their category. 824 holdings, that's a lot for a mid-cap value fund. But as we talked about before, they go up and down the cap spectrum, as well as go into blend and core stocks and growth stocks. So you see this here showing up in, sort of that all cap, all world mentality. They have almost 41% of the portfolio is invested in non-US stocks. So they do have restriction at 35%. So what that means is when international stocks become more than 35% of the portfolio, they can't add to that position anymore. So it's gone from 35 to almost 40 just based on the appreciation of those stocks outside of the US. So what you see the manager saying here is even though those stocks have appreciated and become a larger part of the portfolio, they're not ready to sell those stocks yet to bring it back in balance. So that tells you a little bit about what they're thinking there as far as where they'd like to allocate the stocks in their portfolio. When you look at specifically the top 10 holdings, it's interesting here, none of the top 10 stocks would actually be considered a mid-cap value stock, but all of them together with the other, 90, all the other stocks in the portfolio bring it into a mid-cap value category. So you have United Healthcare Group, which is the biggest holding at 4.5%. They're a large cap core stock. Anthem, their 10th biggest holding, is a large cap value stock. But across the top 10 and across the whole portfolio, you see them jump around a little bit in terms of style box. You also see some international stocks on this list as well. So that makes up that 41% of the fund that's outside of our borders. Expense ratio. So we always look at this in terms of not necessarily highest or lowest, but what you're paying, are you receiving value back for that you're paying for a management team here to pick the stocks? Are they producing for you, or would you be better off with just simply buying that index fund, the list of stocks, so to speak? So this fund comes in at 78 basis points or $7.80 per $1,000 invested. The category as a whole averages out to 93 basis points. So you'll see them significantly less than the category average. Part of that is because of Fidelity is sort of known for that. That's one of the aspects of their group. And also the size of the fund lets them bring that expense ratio down a little bit. So that's a little bit of an advantage to being in this fund versus some of the other actively managed funds in that mid-cap value category. When we look at that expense ratio, we say, okay, 78 basis points. Well, what are we paying for? Has that outperformed the rest of the mid-cap value funds in their category? And the answer is yes, 6 out of the last 10 years it has. But if you look closely in year by year numbers, for example, if you look at 2016, the fund did almost 9%, which is, a pretty good number, obviously, but the category did over 19. So you had a dramatic underperformance against the category there. And then in 2017, it kind of went the other way. So you had the fund up over 20% and the category was up over 13%. So that's that active management coming into play. This certainly isn't a fund that you'd consider an index hugger or even a category hugger, meaning it's not staying that close to what the category or the indexes do. It's going around and just looking for the best opportunities available rather than just what the index tells them to buy. So let's take a look at that index. We talked about the Russell 2000. This is the index we're comparing it here performance-wise. You see that 2016, 17 back and forth here, but it has outperformed 7 of the last 10 years. So this fund has beat the benchmark, has beat the index. So if you were in this fund, you did better off than if you were in the index. Overall, I give this fund a B+, and that's comprised of a few different things. On the return, I give it a B. Overall, the return has been very good, but looking at this from a 401k perspective, sometimes that deviance from the index or from the category can pull them into making a decision, say, I want to sell that fund, or maybe you want to buy that fund because it had a big year. So we really don't want those performance numbers to drive activity, because as we've seen, you can have a big down year of underperformance in this fund, and then it gets that back the next year like it did. So that's the reason I pulled that back a little bit. Overall, the risk of this fund as compared to its peer group is a little bit less, and that is because they grow across the spectrum a little bit and because they do have so many holdings. You'll see funds here, you'll see funds that are considered concentrated mutual funds who might only have 40 or 50 stocks. So being well over 800 helps their risk profile a little bit. So we give them a B there. On the firm side, we give them an A. Fidelity's got a long track record of good, solid, actively managed funds. We think of them a little bit more on the index fund now that they've become so competitive, and even some of their, zero cost funds. But they do have a strong track record of actively managed. And it's a firm, they've run 350 different mutual funds. So we don't have to worry about any, firm level risks or anything like that. For additional research, you can always go to Fidelity. They've got a great website. And we always talk about Morningstar too. They've got some great tools for the individual investor. If you're watching this video on YouTube, be sure to check out our Facebook group, because that's the place where you can see which funds are going to be voted on and have a say in terms of which get the more in-depth analysis like Fidelity Low Price did this week. You can also, if you're in that Facebook group, check out the YouTube channel. That's where you're going to see those shorter videos, the 2-minute videos based on the funds that weren't the overall winner for the week. So be sure to check out both areas. One thing I do want to touch on is the share classes. So you do have a couple different share classes available here. You've got FLPSX, which we use the numbers for this video. Got a 78 basis point expense ratio. And then you've got FLPKX, which has a 69 basis point expense ratio. So a little bit less expensive on that K class there. So if you do have access to that and you can get in that fund, that might change your conversation or your analysis a little bit, because you can adjust those performance numbers, maybe 10 basis points higher, if you do have access to that K class. But like I said, overall, this is very good fun. You do get that active management. It's certainly not an index hugger, but you wouldn't want to put all your portfolio in this fund, obviously, but it is a good complement to another well-diversified portfolio. Thanks for watching this video.